You want to be rich, right? Of course you do. Everyone wants financial freedom, but achieving that dream requires more than just wishing for it. One of the biggest keys to building wealth is starting early. The earlier you begin, the more time you have to let your investments grow. It might seem like a small thing, but starting to invest even a little bit when you're young can make a huge difference in the long run. Small, consistent investments can snowball over time. Think of it like this. The earlier you start, the more time your money has to grow. Just like a plant needs time to grow from a seed to a full-grown tree, your investments need time to mature. It's like planting a tree. The younger the tree, the more time it has to grow tall and strong. The younger the tree, the more time it has to grow tall and strong. Similarly, the younger you start investing, the more time your money has to grow and benefit from compound interest. Starting young gives your money more time to benefit from the magic of compound interest. Compound interest is like a snowball effect, where your earnings generate even more earnings over time. We'll talk more about that in the next section. But for now, remember that time is your greatest ally when it comes to building wealth. The bottom line is, the sooner you start, the better. Time allows your investments to grow and recover from any market fluctuations. Don't wait until you're older and have more money to invest. The best time to start is now, regardless of how much you can invest. Start now, even if it's just a small amount. You'll thank yourself later. Your future self will be grateful for the decisions you make today. Compound interest is the secret sauce of investing. It's a powerful concept that can transform even the smallest amounts of money into substantial wealth over time. It's how your money makes money, and then that money makes more money, creating a cycle of growth, and then that money makes more money, and so on. This cycle continues, allowing your investments to grow exponentially. Over time, even small amounts can grow into significant sums. Just like a tiny seed can grow into a mighty tree, your small investments can become a substantial nest egg. Imagine you invest $1,000 and earn a 10% return. That might not seem like much at first. The next year you haven't just earned 10% on your original $1,000, but on the new total of $1,100. You've earned 10% on $1,100. This means your returns are growing each year. The growth compounds year after year, creating a snowball effect that accelerates over time. The longer your money compounds, the more powerful the effect. Time is your greatest ally in this process. That's why starting early is so crucial. The earlier you begin, the more time your money has to grow. You give your investments more time to snowball into something substantial. This can make a huge difference in your financial future. Don't underestimate the power of compound interest. It's a simple yet incredibly effective way to build wealth. It's like a financial superpower. Harness it wisely, and watch your pennies turn into dollars. Many people wait for the perfect time to invest, hoping to catch the market at its lowest point. They might wait for a market dip, thinking they can buy stocks at a bargain price, or try to predict when stocks will be at their lowest, constantly monitoring market trends and news. Here's the truth. Trying to time the market is incredibly difficult, even for professionals with years of experience and advanced tools. It's tempting to try to buy low and sell high, but it's often a fool's errand that can lead to missed opportunities. You might miss out on big gains while you're waiting for the perfect moment, as the market can surge unexpectedly. Remember, the stock market tends to go up over the long term, even with occasional dips and corrections along the way. Instead of trying to time the market, focus on time in the market. This means staying invested and riding out the ups and downs. Invest consistently, regardless of what the market is doing on any given day, and take advantage of dollar-cost averaging. This strategy is much more likely to lead to long-term success, helping you build wealth steadily over time. Section 4. Knowledge is power. Understanding your investments. Before you put your hard-earned money into anything, you need to understand what you're investing in. Don't just blindly follow someone else's advice or invest in something because it sounds fancy. Take the time to learn about different asset classes like stocks, bonds, and real estate. Understand how they work, their potential risks and rewards, and how they fit into your overall investment strategy. There are tons of resources available to help you learn about investing, from books and websites to financial advisors. The more you know, the better equipped you'll be to make informed decisions about your money. Section 5. The long game. Patience and consistency are key. Investing is not a get-rich-quick scheme. It's about building wealth gradually over time. This requires patience and consistency. There will be ups and downs in the market. You might see your investments lose value in the short term. Don't panic. Remember, you're in it for the long haul. One way to stay disciplined is to automate your investments. Set up regular contributions to your investment accounts, even if it's just a small amount. This way, you're investing consistently without even having to think about it. Remember, building wealth takes time. Be patient, stay consistent, and you'll be amazed at what you can achieve.